to welcome Andrew Bailey, Governor. Thank you very much indeed for joining us, Governor. And also, I'd like to put on the record all our thanks for you and your team's letter and input that you've already sent for our inquiry. We're very grateful. I should also declare an interest, as I always do, as an advisor at Banco Santander. I always start our oral sessions with a starter for 10, so to speak, and it's a very broad question, so I'd be very grateful if you could try and keep your answer as brief and succinct as possible. And it's a very simple question, which is, when you look back to the period since 1998, what do you consider to be the success and failings of an operational independent Bank of England? And I'm particularly interested in what you consider might be the failings.
Yeah, so I think the success, in a very broad sense, is two things. It's the clarity of the primary objectives and the institutional independence that goes with them. So in other words, it's the institutional ability to put those objectives into practice. And I'll give you one example. I'll go on to the failings. I mean, I think the statement that I've made a number of times recently following the failure of Silicon Valley Bank, that the UK banks are safe, they are robust, and they can serve the public, is an important. It's built on that. It doesn't come from nowhere. I think, going to the other side of the question, I mean, I'd probably draw out 2 points. One's historical and one's contemporary. I think the historical, frankly, issue, of course, was in the pre-financial crisis period. We didn't have an explicit financial stability responsibility or an explicit financial stability objective. Indeed, the objective was, I think, for the system, for the structure as a whole, was quite obscure. And I think that that told, as it were, in the contribution. I mean, you could spend a lot of time trying to sort of run the counterfactuals as to what would have happened. And obviously there were important things going on in other parts of the world, but I think it mattered in the UK, certainly when I compare it to the situation we're in now. The second thing is contemporary. I think we're obviously in a situation of very big shocks have hit the economy. Now, I take the view that this is the point at which those clear objectives and the clear target for price stability is essential as the sort of the anchor. But as I've said to the Commons Treasury Select Committee, there are obviously lessons to be learnt, I think, particularly about how we respond to the scale and nature and sequence of the shocks that we've had. And there'll be important lessons to be taken from that, no question about that.
Can you just put a bit more flesh on the bones about what those lessons are then?
Well, I think the lesson, and obviously we're still in it at the moment, so I'll qualify it in that sense. I think the lesson for me is that, coming out of COVID, so from second half of 2020 onwards, we had a series of very big supply shocks. 2 of them were international, one of them I think was domestic. So the so-called supply chain shock and the recovery from COVID was global. Then we had, obviously, the war in Ukraine is obviously and sadly international. And then we've had a domestic labour supply shock as well, and that was obviously domestic. And I think the sequence of those, because there's no gaps between it has turned out there are no gaps between those shocks. And the scale of them has provided a very big challenge. And I think we will obviously have to look at what are the right responses to those challenges. Always, I have to say, and a point I make in other hearings, is bearing in mind, of course, what I call the hindsight point. That we don't set policy with hindsight.
So what would be the processes that you would be looking at when you say that there are lessons to be learned?
Well, although we haven't formally decided yet or announced, I would expect, because it's what we do, and obviously we sent you a letter setting out quite a lot of reviews we've done over the years, that this will be something, we'll define elements or this to something we'll do a review on, because it would be sort of, I think, really, we wouldn't be doing the right thing if we didn't do it, frankly.
So I'm just interested in this because you're quite right. You did send a very useful letter which pointed to the reviews you've done in the past. And one of the reviews that concluded in 2015, picking up on a review that was done in 2012, concluded, which was the Stockton Review, said a core theme of the Stockton Review, which is 2012, was the need to take steps to introduce greater challenge to forecast conventions and bank thinking. And it goes on to point to the forecasting, which we'll come on to in a minute, itself. How much do you feel, though, that one could call it criticism, learning, whatever you wish to call it, certainly a conclusion of this report, has actually been acted on since 2015?
Well, the point I would make to start with is that I do read, and I've read some of the other hearings in the review you're doing, that talk about, the bank's got a model and the model isn't doing well. And it isn't, I'm afraid, like that at all. We don't have a single model. We have really something Lord King introduced, actually, quite a suite of models that we can put to work. We actually develop new ones as time goes by. But also, and this is where the challenge comes in, and this is where I think the Stockton Review was helpful. I wasn't on the committee at the time, but I do remember it happening well. Is that the job of the committee is to challenge those judgments and to introduce their own judgments and to form those into changes to the forecast that seem appropriate given the economic situation we're in. So this idea that there's a sort of a sausage machine that sort of you stick things in at the end and a forecast pops out, and it's really not like that at all. And just to illustrate that, the two things that I would point to in the current situation is that the committee is making very big, and has been for some time now, very big adjustments within what we tend to call the modal or the central forecast to the persistence of inflation. And those are judgments, really. And secondly, we've got the biggest ever upside, what we call upside skew. So in our fan chart, the distribution for inflation is at the highest ever in terms of the upside risk. And that's, again, a judgment of the committee.
Okay, I'm going to bring in Lord King, conscious we might be voting shortly.
Mr. Governor, welcome. And you've been a participant and an observer in the whole process of setting monetary policy during the 26 years now of independence, and indeed right back to the inflation target introduction in 1992. And you've been able to observe some parts of it and actually played a role in parts of it as well. Given all that experience, what would you say needs to be improved? Are there things that you think need to be adjusted or improved in the framework?
Well, I do think we've moved into an era where we've got we've had very big supply shocks operating on the economy and on inflation. I think those call into question, what is the right response to that at the time? Did we, and I think this is what we will need to review is did we look at that broadly enough at the time? I think for me the biggest challenge in there is the labour market in 2021. Ukraine, I think, although Ukraine sadly is possibly having the biggest effect on headline inflation, I'm afraid I do take the view that really, I've read some of the books. It was only in December 21 that even the intelligence sort of sources were saying, this is looking much more serious than previous sort of Russian troop build-ups. So I would say, I don't think really on Ukraine, monetary policy is going to solve that problem. We have to deal with it. I think on the labour market, the real challenge, and this is the difficult one, was that, this is an issue we spent a lot of time on in 2021, was the furlough scheme, which was extended from April till September, ended at the end of September 2021. And right up to the last day, I think there were a million or so jobs on the furlough scheme. Actually more than I think certainly people expected there to be. And the question for us was, what's going to happen when the furlough, what's going to be the consequence of that scheme ending? Are we going to see slack in the labour market in the sense that there are people who are not going to have jobs to come back to? Now, that was, frankly, as I remember at the time, the judgment of most commentators. We were probably at the lower end, but we thought unemployment would rise. We were wrong, frankly.
Well, that's about a sort of economic judgment.
Yeah, but there's a lot
which can happen at any time. But what about the actual framework? The inflation target itself, one of the areas that some witnesses have raised with us, and indeed, if you remember, it was raised right back, actually, when the independence started was that the government gives the bank the inflation target. It doesn't give it any explicit instructions about the horizon over which to bring inflation back to target. You can't bring it back immediately because it's a 12-month measure. You'd have to, you're oscillating between deep recessions and booms. So it's bound to take time to come back. The question is, at present the committee makes a judgment as to the appropriate horizon over which to bring it back. Is there any role for government to have a say in that? Or are there any other aspects of the actual framework itself that you would like to be able to adjust?
Well, the 2013 amendments to the framework did give us more flexibility over this very point you make about when, how quickly to bring inflation back to target. It cast it in the sort of context of a trade-off. So it did create more flexibility, and it's something that we do, I mean, particularly in the current context, do spend quite a lot of time focusing on as to, you know, how quickly to bring it back to target, accepting all the uncertainty around the judgments we have to make in that. So I think we have the framework to do that. I think there's a challenge in there, going back to what I've just said, between how much you explain your judgment about how, you know, how rapidly you think is sensible for it to come back, and frankly, as you know very well, the uncertainty around those judgments, which is substantial, frankly. I think the fact that we've got more flexibility now as a result of the 2013 changes, I think is helpful. I think those, you know, I've got slightly different views on some parts of the 2013 amendments, but I think that one probably, I don't know, I think probably usefully formalised something that, I mean, you know better than I would, that was sort of in the minds of people before.
Moving on from that, there are a couple of things that follow on. One was there were changes to the procedures about transcripts of meetings. Yeah. And if you remember right at the very beginning, when the bank was independent, people tried to make a transcript of the proceedings.
It didn't go well.
Because it wasn't a series of formal statements around the room, it was a genuinely interactive conversation. And the transcribers who listened to the recordings couldn't work out who was speaking. Do you think that the idea of transcripts, which is now embedded into the process, makes a lot of sense?
Well, the first ones will appear next year, in fact. I think
it appears next year?
Yes, I think so.
It's a 5-year lag or an 8-year lag?
It's 8.
8-year lag.
I hope I'm wrong. If I'm wrong, I'll correct you, but I think it's 8. Sorry, I think it's 8. We do it it's slightly different to the Federal Reserve, so the whole of the FOMC is transcribed. The whole meeting from end to end is transcribed. We have a series of meetings, some of which are taped and transcribed, and one or two of which are not early on in the process. So we have you'll remember, well, we have what's called a briefing meeting. It's still called the pre-MPC meeting. That hasn't really changed at all. That's not transcribed because the staff are sort of, in a sense, downloading to us what's happened since we last met. Then we have what we call an issues meeting, where we actually, that's not transcribed, and we do deliberate quite freely on the issues, but we don't reach conclusions on policy. And then we go into the next meeting is taped, when we give our indicative views. Each of us gives an indicative view. And then there's a final meeting, which is actually quite short, where we confirm or not those indicative views, and then we go into the minutes creation. I mean, I think it's important to have that mix, because my judgment, I wasn't on the committee, but obviously before the transcription process came into being, so I'm having to sort of judge this slightly from afar on that. But I think it does have an effect on deliberation. So it's important that we have the opportunity to deliberate without that, because I think the essence of the MPC is that 9 people deliberate on the evidence as they see it, and we, and each of us reaches a judgment on that, informed by listening and talking and deliberating with the others. And if I felt that the deliberation had disappeared out of the process, I would be very worried and would want to do something about it. So I think we've managed to preserve that. But I do think, and I think you can see this in the FOMC if you go back in time, that I think it does have an effect. People want to prepare. If you're on tape, you prepare your remarks. There's less give and take, I would say.
In your first answer, you talked about some of the lessons that might be learned and what you'd be doing to discover what those lessons are. Why did inflation go up? So, what's your theory of inflation?
Why it's gone up?
No, what's your theory of inflation?
Well, I mean, it's the balance of supply and demand, ultimately, in the economy. Now, the economy is hit by all sorts of shocks, but ultimately it is the balance of supply and demand. I do take the view, I know a number of people have said this, there is a monetary impact, there's a money impact to that, so I certainly don't ignore that, and I'd be happy to sort of expand on what I think we've seen in recent years on that front. But I think the balance of supply and demand across a number of sort of parts, so it's not just obviously in activity, it's also in the labour market, is key to that. Now, I think the challenge we always have, though, is that measuring those things looking forwards depends on us essentially reaching views on things that are sort of unmeasurable, in a sense, on sort of gaps, the sort of gapology in the economy, and I think we have to be very cautious about how we interpret that. But I think, ultimately, I think you can boil it down to quite a lot, and I think you need to do that. I think we have to keep it, keep it as simple as we can, ultimately.
Tell us a bit more about the monetary side to it, because it's not easy in the monetary policy reports to see much reference to that, but you said it was still something that you...
Well, I mean, the example, this is the almost contemporary example I would give. And I'm going to sort of slightly both expand and qualify some of the things that I think have been said in previous hearings. So again, if we look back to 2021, say, as a number of people have said, yes, you saw rapid growth in the M4 aggregate. What wasn't said is that the other aggregate measure of M4, which is M4 lending, was not growing rapidly at all. In fact, it was doing the opposite. And this was almost, I think, unprecedented, that there was this gap opening up between the two. Now, in the committee, we discussed this a lot, and the sort of rationalisation of this we arrived at, but it then posed a question, which I think is still with us, actually, was that what we were seeing was quite a strong build-up of saving in the economy. So that sort of helps to explain the gap between the two measures. And I think it was useful that the monetary aggregates, in a sense, were giving us that picture quite starkly. Now, we then had to obviously form a view, well, we've got this build-up of unexpected saving. We can sort of rationalise it in a sort of COVID context because, people were not able to, to hold that force.
Sorry, Governor, I'm going to have to suspend the sitting for 10 minutes. So I'd ask members to be back here at 15:36. Thank you.
Just right.
Suspended. The proceeding is currently 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 suspended.
Right, we'll now resume our hearing. So you were in the middle of an answer.
Yes. I think correct me if I'm wrong, I think I just said that the committee was left with an issue in the sense that we had a build-up of unexpected saving. We thought the distribution of that was not even across the population. It was probably more in the sectors of the population have a lower marginal propensity to consume out of saving. But we had an issue in 2021, and we still have it to a degree. I'll come to that as to what is going to be the effect of this build-up of the stock of money. And I think we see it now, and I think you do see this in I observe it in a sort of this is where some of the sort of the more sort of monetary inclined economists fall out amongst themselves, which is it the flow or is it the stock, or is it some combination? Because certainly at the moment, I mean, the flow measures of M4 would tell you it's weak, it's weak and weakening, but we know. I mean, we don't know how much. We never knew exactly how much was out there. We think the stock has now eroded. Certainly in real terms, it's eroded. But to what extent that stock still has some overhang is a judgment we have to keep coming back to. So I hope that helps to explain how certainly I think about it, and how the monetary aggregates do inform that. But it's a little bit, frankly, a bit more developed than some commentators would suggest.
Well, it might be helpful to have some of this discussion and ideas reflected in the monetary policy. Right?
That's a fair point, yeah.
Because we looked in vain for references to money and so on.
Yes.
Lending, yes, but I think the way you've described it will be helpful to see more of that.
I think you'll see it in the discussion on saving. I don't think you're right, and I think it's a fair point that the link back to the money, to the monetary aggregates was probably not there.
I mean, earlier on today you said that obviously you don't use a model as a sausage machine. It's sort of assumptions in, answer out. You told the Treasury Committee that you've sort of aim off the model somewhat.
Yeah.
One of the problems with the model is that, if I remember, I can't really think it's changed, that actually it doesn't really matter what you do, inflation in the medium term always comes back to 2%.
No.
And that bit is what you need to aim off for,
Yes.
clearly. Can you say a bit more about how you aim off?
Yeah, so you're absolutely correct that the problem we have at the moment, and I would say it's not just a model, it's models actually,
Yes.
is that they tend to be highly linear and highly symmetric therefore. So in other words, what goes up comes down more or less with the same profile. So that's of course particularly relevant at the moment because if you were to leave the sausage machine to run on its own and just sort of take it as it was, you would find that the forecast would deliver a very rapid fall in inflation, back to and indeed below target, well below target, driven by this sort of linear symmetry sort of condition that is in there. And we have aimed off that. We don't. That's not our central view. It's a long way off our central view. We think there is more persistence in inflation, and therefore we've introduced more persistence into it, and we've done that in a number of ways. I mean, some of it, the staff have estimated sort of little new models, as it were, to try and help us do that, and then some of it is judgment. A lot of it is judgment. Frankly, it's judgment. We've said, well, this is what we think will happen. How can we then reflect that back into the forecast? And of course, as you know, the judgment then on the risk is entirely judgment. I mean, really.
The model basically builds in the view that inflation is always and everywhere a transitory phenomenon. It always has to come back to the target, and you have to use judgment in order to sort of override that.
Yeah.
Can you just say a little bit more about the variables or the analysis that you use in order to decide where inflation will come back to, or maybe it won't?
Well, it will, because we will have to use monetary policy to bring it back. I mean, frankly, and then the question, of course, is how much, frankly. So I mean, I would point to two things in the current assessment that I would sort of pick up in that respect. One is more sort of structural, and the other is more a condition of the time. So the structural point really is around the labour market, actually. And what I would say is that, as I'm afraid this morning's numbers illustrated, we've got a very tight labour market in this country. We've had a fall in the supply of labour, which is showing signs of recovering, but very slowly, frankly. And I would also say, and as you know, we've got our network of regional agents who provide us with a lot of information that informs these judgments. As I know you did, I mean, I go around with the agents a lot visiting businesses. We've got 12 agents. I say I will spend a day with each one of them every year. And one of the things that firms pretty much universally say to me, and have been saying to me for a little while, is that they find it so hard to recruit labour in the current market that they are not going to release labour. There's labour hoarding going on. That they'll adjust hours if they need to, but they will be very reluctant to make people redundant, effectively. So we've taken that, and again, we've built that into the judgment on the labour market, and therefore on the tightness of the labour market and how that's going to get reflected through into price setting, wage setting, and inflation. That's one thing we've done, and we've had to come back to that a number of times, frankly, over time, over the last year or so. I mean, the second one, which we spent quite a bit of time on in the May round forecast, is food. And the question which we start with, which is that at the world commodity price sort of start of the chain, food price, obviously very heavily affected by Ukraine, but at the world level, food prices peaked actually last summer. So why is it taking longer in this era than it has in the past for this effect to come through? Notwithstanding the fact, and again our agents tell us this, and I hear it, more so by the retailers than the food producers. We've been being told for some time, no, they've reached the peak, they're going to come down, they're going to, the rate of inflation is going to come down. And then the contact's coming back later and saying, well, sorry, we got that one wrong. And so we've had to sort of go back and look very hard at what do we think of we've got some ideas on what the underlying drivers are. I mean, we still think the rate of inflation is going to come down, but it's taking a lot longer than we expected. So again, we have to introduce, we introduced an explicit, in a sense, persistence of food inflation into the forecast in the most recent round.
Thank you very much.
Lord Griffiths.
Mr. Governor, I've been asked to ask a question about groupthink. And from one perspective, it's very clear there is not groupthink. And that is on the Monetary Policy Committee, people have different views, they express different views, they vote differently. That's not groupthink. On the other hand, as has already been touched on already, there is one area where there does seem to be groupthink. And you may say, but it's a groupthink within the academic economics profession, which is the sort of standard macroeconomic model, the new Keynesian model that people are using and so on, where there is no role for money. And following on from the last questioner, as you read the reports, the detailed reports of the Monetary Policy Committee, there does seem to me, and I use strong language here, there seems to be a willful neglect of handling money, despite the fact of 18th century, 19th century, 20th century, money has played an important role in many people's view of inflation. But somehow, money is never mentioned. It's one asset among many others, and there's nothing distinct about it. And there's no sort of urgency somehow about treating money. And it's very interesting that in the MPC, between March 2020, when COVID first hit the scene, and when interest rates were raised by 0.15%, there was unanimity among the MPC. It's one of the few occasions when there's been that sort of unanimity. And therefore, my question is, on the one hand, you talk about, as you did to the last meeting when you were called for give evidence in the other place, you talk about the supply side shocks, COVID, Ukraine, the labour market. All of those supply side shocks are outside of the Bank of England. But the money supply shock, to me, is something that's under the control of the Bank of England, but somehow is not mentioned. It gets lost in all these other assets in the system. And I suppose my question is, why is it that somehow there seems to be, I don't know, almost a fear of using the word money stock, as if you then become a monetarist. Monetarism is ideology, which I don't think it is. It's simply a proposition that if you increase rapidly the stock of money, a broad stock of money, you'll have inflation. But that's what it's a long question, but that's where what I'm struggling with.
Well, first of all, I don't subscribe to any view that is sort of ideology. I'm entirely with you on this. I think, I have to say honestly, I think it comes back to the response I was giving to the question that Lord King asked, which is, I think the dilemma we had at that time was between what I call the sort of the stock and the flow interpretation. The flow was the flow. You're right. The flow of the aggregate of money was very rapid, because we knew that in a sense. I mean, we're not obviously blind to that. We were seeing, however, a very different picture in terms of credit creation in the economy. And when you look at those, I mean, I'd be happy to send the chart in if it would help the committee of the two measures. And looking back over a long period of time, over sort of 30, I think we go over 40 years or more, it is, I think, almost unique to see these two measures of money move in very different directions. So we have to, I take Lord King's point that we could draw this out, we should draw this out more, but we have to try and interpret that. That's our job.
Can I say that if something we've heard from witnesses, which I think is a very fair point, there's a difference between being a central banker and an economist working in a central bank. They are two different things, and therefore, as a central banker, you must make these tough calls and so on.
Yes.
And all other central banks in the world had to make the same tough calls. And frankly, you were there in a huge majority of, and even others who would have placed a stronger emphasis on the money stock were saying in mid-2020, of course it was the right thing to take the brakes off, otherwise we could have ended up with a Great Depression. But I'm just, I like Lord King, I think if there was some move made in the monetary policy reports, or at least some recognition in even speeches, or even a paper presented by somebody, that money as opposed to credit did have a role, because money is something you pay with. Credit is something when you defer payment and you borrow. So they are different. Credit and money are different things.
I think if you go back to 2020 and the response that we had to make in 2020, it's worth remembering the economy. GDP fell by over 20% in the initial thing. I've noticed some of the other people who've appeared here. I don't think sort of particularly question the 2020 policy stance. I think I would agree with them. I think 2021 is the really hard part when it became very hard to judge what was going on. And I come back to this point about the distinction between the stock and the float, because one of the things that I do hear some people saying, and I have to sort of, I do dispute this, is, well, the economy had a very strong recovery. Now, I think you have to be very careful about the context of saying this. Yes, it's true that in the summer of 2020, having fallen over 20%, if you only look at that point in time, there is quite a rapid recovery. But the UK economy has actually not recovered rapidly. The level of GDP is still actually marginally below where it was pre-COVID even today. So that recovery was not strong in that sense. The recovery of demand in the economy was not strong. And then, but we were, of course, then hit by these supply shocks.
Lord Blackwell.
Can I just pick up, Governor? You've said that the recent inflation is driven by supply-side shocks. Given the lessons that you learned over that period, if you could rerun that period with a different monetary policy incorporating those lessons, is it your judgment that the peak in inflation could have been significantly lower, or the trajectory lower?
Well, I always have to caution, because this question comes up quite often in the other house, that we don't have the benefit of hindsight when we set policy, and I'm very concerned. Obviously, historians and so on are going to come back and look at it with hindsight, and that's absolutely the right thing to do, but that was not the luxury that we had. We have to make the decisions at the time based on the evidence we have. Now, I think that you can, of course, and this is another good thing to do, you can rerun the real-time evidence, and people should do that and say, well, were they doing the right thing at the time based on what they knew at the time? And that's fine. Happy to do that. But to say, if you'd known a war was going to break out, or if you'd known that the end of the furlough scheme was going to be different, what would you have done? Yes. And I would say this. Although I'm cautious, because this is modelling again, and I'm very cautious about it. One of the things that obviously I think we should be careful of saying is, this type of shock with its terms of trade component to it has had a very big effect on national income. If we had known it was coming and tried to offset it with monetary policy, we would have had to raise interest rates very substantially in advance of it, and that would have had its own consequences, frankly.
I wasn't suggesting hindsight in the sense of being able to know things that you couldn't have known, but you said that you've learned some lessons over this period.
Yes.
So I'm just wondering how you would have applied those lessons to monetary policy.
Well, I think one of the lessons that we've got to go back to is the question, obviously, as to what the right path of interest rates was. But again, you have to say we had to base it on what we knew at the time. Yeah, we were genuinely puzzled by the labour market for much of that period, going through 2021, and then after the furlough scheme ended as well.
I'm troubled a bit by some of the vocabulary that's used. We have an underlying rate of inflation, then we talk about a shock, and then the word temporary comes in. And sometimes the shock and temporary are equated.
Yeah.
I don't think that's actually helpful. If you throw a small pebble in a pond, the ripples don't go very far. If you throw a rock in, those ripples go on a long time. The power explosion, that wave thing actually went on for several years. So the temporary, you can have something that is a shock, but it could have quite long-lasting consequences. And I wonder whether the mentality of thinking that because it's a shock, you underestimate the fact that its effects could go on, rippling through the economy for some time.
That's a very fair point. I mean, this is a very good question because, again, it goes back to the situation we had in sort of 2021, particularly first half of 2021, where it looked to us that we obviously could see the sort of the supply chain, the global supply chain shock. We could see shipping costs rising. We could see some commodity prices rising at that point. We could see disruptions to trade going on at that point. And we could see this shift caused by COVID from demand for services to demand for goods, particularly in the US, but somewhat here as well, actually. And the question was how prolonged was that? If that was the one thing that we could see at that time, bear in mind the war hadn't started, the labour market hadn't really evolved at that point to what we subsequently saw. How long was that shock going to go on for? Well, what we now know is that shock probably peaked probably a year ago or so. It's now substantially now waned. I mean, shipping costs are now back to where they were pre-COVID, for instance. China obviously got through the end of zero COVID much more easily than people feared it would. So, yeah, if that had been the only shock that we'd had, I think we'd probably be having a somewhat different conversation. Yes, inflation would have gone up, but it would have probably come down again as well, I think, and monetary policy would have responded, as appropriate. So I had to be okay because I know that the word transient, temporary, transitory, call it what you like, is not the word to use these days, and for obvious reasons, because we've had this sequence of shocks, and you can't distinguish between them. There's no air gaps between them, so it's now a very prolonged period of supply shocks. But I think the question of when we were looking at one shock is still a somewhat different context.
Can I just tease this out, just 1 second? Can I just tease this out, Mr. Governor? So what you're saying is that the lessons to be learned are not so much from the period pre-Ukraine, but post-Ukraine, is that right? So you would stand by the fence that if we hadn't had Ukraine, inflation would have been transitory?
I think it's actually it's actually post when we could see the effects of the end of the furlough scheme, which really, given the lag in the labour market data, is really sort of November 2021 onwards. So it's a little bit before Ukraine, but not that much.
Right, sorry, Lord Davis.
Just to be sure I'm following this, one of your colleagues or you said in evidence to the Commons Committee that even if you had all the foresight, inflation would, and you'd used every instrument in your toolkit, inflation would have still got to 8%.
Well, we would have still had supply shocks because obviously those things have come from outside. And I'm not sure about the 8. I've not used 8% certainly, but
yeah,
I think
someone did.
Somebody may have done it. I don't know. Yes, I know 1 or 2 of my colleagues have done modelling on this. That has the strength of illustrating the story and the weakness, as Lord King was saying, and I was responding, of being overly precise in terms of what would have to be done. But if we'd been able to anticipate that, I mean, we would have obviously then had the decision to take about how we would set policy in the COVID era, knowing what was going to happen next. That would have been a very tough call.
Yes, because of the implications in terms of double-digit unemployment. I think that, again,
yes, that's
what the other witnesses said.
Yeah. Sorry, just to labour the point, just to be clear, the lessons to be learnt then are which period? So is it in the pre or post-Ukraine period that you feel we need to be learning?
Well, I think it starts a bit before Ukraine. because I think the labour market shock is very important in this respect. And that starts to emerge somewhat, not long, but somewhat before Ukraine.
Lord Griffiths, sorry, did you want to?
Yes, very quickly on this labour market shock. It seems to me you put a lot of emphasis on the labour market shock, and indeed it was a shock. It's a supply side shock, and it's a very tight labour market. On the other hand, I think if I put myself in the position of a trade unionist today, thinking of negotiating prices, I'd sort of ask, what is the outlook for inflation likely to be? Well, you look at the OBR's predictions on the public finances, and you find that for this year and the next 2 years, the borrowing requirement is rising, and relative to GDP just comes down in the 5th year. You also see that there's tremendous demand for public spending on defence, the NHS, social security, and so on. You now hear on the paper this morning, the headlines, the Chancellor starts talking about tax cuts. So I look at these and then I think, well, now if I was in the position of the Governor of the Bank of England, I don't want to be accused of creating too much unemployment. So with all of this, I say to myself, it is a tight labour market, but what kind of wage bid am I going to put in? And my question is, you make a very good point in emphasising inactivity in the labour market, but it also seems to me, given rational expectations looking forward, there's a very strong case for when you put in a wage demand, putting quite a big expectation of future inflation into it. And I just wonder how you balance those.
Well, it's a very good point. I would actually say there's another little dimension to what you've just said, which is the question, if you are in that position as a wage bargainer, to what extent, how you balance what I call backward-looking expectations and forward-looking expectations. And this comes back to this question about how fast is inflation going to come down, and what sort of, in a sense, what probability do you put on that? Because of course, if you use backward-looking expectations, you're going to get a high inflation number if you weight it towards recent backward-looking expectations. Now, we do think we continue to think headline inflation is going to fall this year because some of it's arithmetic because of the base effects, the annual base effects with energy prices, given energy prices are much lower. I mean, we still continue to believe that food inflation is going to come down, but it would be really rather better to actually see it happen. So the question, if you weight more towards forward-looking expectations for headline inflation, you would have a lower profile. Now, you can obviously imagine which I would prefer people to use, but the question for it, that's not. We have to make the judgment. What do we think people are going to sort of do in terms of weighting? By the way, I mean, obviously the monetary policy framework and the anchor of the inflation target is also critically important here because we want it to be very clear that we're going to bring inflation back to 2%.
Thank you very much. Baroness Liddell.
Given the complexity of some of the issues that you've been talking about, some of the things that you have to grapple with, do you think that the remit of the bank has become overly complex? And how do you manage the trade-offs between the primary and secondary? Because we've certainly seen from a lot of our witnesses a belief, they argue that climate change is not a central bank goal. So what do you think of that?
Yeah. Well, it's a very good question. Can I start? There really are three remits. There's a remit for each of the policy committees: the Monetary Policy Committee, Fiscal Policy Committee, the Macro-Prudential Committee, and then the Prudential Regulation Committee. They all have different remits, and they're all different in structure. So, if you don't mind, I mean, it's useful to just lay them out briefly. The simplest is the monetary policy remit because it goes right back to 1997. It's a single objective, primary objective of obviously price stability, and everything else is what I call hierarchical because it has this language and it's subject to that. And I think you were a Treasury Minister, so we owe you a great thanks for this, and Lord King as well. That's critical because it is actually pretty straightforward. I mean, the subject to that is government. The government can tell us what its policies are. But actually, it's hierarchical, so there's no question that the primary objective is price stability. The other two committees are not in a simpler position. Now, they're a bit different The Financial Policy Committee, the Macroprudential Committee, actually has... Well, actually, no, let me go to the Prudential Regulation Committee because it's easier to come back to the Financial Policy. So the Prudential Regulation Committee has obviously primary objectives, safety and soundness, policyholder protection for insurers, but then it has secondary objectives. And it also has what's called have regards, things that we must have regard to. Currently, I think there are about 31 have regards. This will come down a bit when some of the new legislation comes through, but it's only going to come down to about 25, I think, or something like that. So each time we make policy, we have to, assess 25, 30 have regards. And we have to do that as policymakers. We can't avoid that. In fact, there was a judicial review recently on the Stonehenge underpass, which the government lost because they had not taken into account properly at the policy-making stage the have regards. The FPC is in the middle, and it's actually got a bit of both. It's got the most complicated because it's got some of the Monetary Policy Committee in the sense that the government can tell us what its policies are, and actually it can go rather further than that in terms of the way the FPC works because it's not as simply hierarchical. And it's also got have regards as well. So the FPC is the most complicated. Now, I would, and this is where something like climate change comes in. It's not really an issue in monetary policy. I mean, I think you can think about how the economy is going to evolve in the future and what the climate's going to do to it, but it's not an issue in current policy setting. In the FPC and the PRC, it is because firms are holding assets long term, which can be at risk from climate transition. My overarching philosophy here is that we must always, in a sense, view the objectives through the lens of the primary objective. So when we have regard to other things, it should be through the lens of the primary objective. I'm sorry if I say this, I'm probably going to come across as being slightly angular in saying this. I have to say all these objectives come from government, and if you don't mind me saying so, I mean, this House added an amendment last week on nature to our objectives, which is proposed to be embedded into the climate objective, which again is an example of how the things, not for the monetary policy committee, but for the others.
Do you think that politicians are outsourcing too much to the bank?
Well, I think we have to be clear that these other things have to be viewed through the lens of the primary objective. So, for me, what we do on climate change is a risk clearly in the financial stability and the prudential world. But we must view it through that lens. We are not, the Bank of England is not there to make climate change policy. That's other people's job, not ours.
Some have argued, sorry, can I just quickly jump in if I may? Some have argued that you should go further on climate change.
Further in which direction?
Further in the sense of actually being more activist, more interventionist.
Yes, look, there are people on both.
Where do you stand?
There are people. I stand very clearly that I think we must be focused on our primary objectives, and that everything else we have to view through the lens of the primary objective. So, if climate change is a risk to financial stability, we clearly have to take account of that. Very clearly, but it's in that context, not. If you don't mind me saying, how can we help the world adjust to climate change? That's other people's objectives.
So what dialogue do you have with government in relation to all these remits coming together?
We do. When we get the remit letters, we do have a dialogue with government. I have a dialogue with the Chancellor. We have a dialogue with the Treasury. They're not subject to parliamentary scrutiny, I think. They're outside that process, I think. But no, we do have a dialogue. And I can tell you actually a couple of years ago, I think there was a proposal on nature a couple of years ago actually, and we did say to the government, and it was adjusted, look, we've got a reasonable sort of body of thinking on the relationship between financial stability and climate. I'm afraid on nature we do not, there isn't a sort of foundation to build that on.
Do you have a dialogue with, for example, the Chancellor before he signs the letter of remit?
Yes, we do. Yes, we do. Yes.
And do you make these points?
Yes, we often make these points. I mean, we do often make these points. I often say to ministers, it's important that we, in a sense, we've got to stay focused on our primary objectives. Now, I think like I think a number of witnesses have said to you, the length of the remit has got remits. Monetary policy a bit different, say that's not changed that much, but the length of the remits has got longer, yes.
So would you like the government to prune the remit? And second, as I was referring to earlier, if you look at the ECB in particular, it is now saying that biodiversity should also become a major focus for its activities. Would you agree on that? For example, Frank Elderson at ECB said last week, this is core economics, tackling biodiversity loss.
Well, it may be core economics or not. We could have that debate. It's not, for me, core to our objectives, our primary objectives as the central bank. What I think you'll find is that the central bank sort of there's a bit of a sort of a range of views on this among central banks as to how far that goes. And I'm certainly very, very clear that we must stay anchored in our primary objectives. But I understand that ministers reasonably say to us, but of course you must understand that how you pursue your primary objectives can affect other things. So competitiveness is a good example here. It has made me nervous. My view is, look, as much as possible, I think we should anchor competitiveness this is in regulation, obviously, in international standards, so in things like the Basel standards, because those are global. That I understand fully. So I'm not, I'm not sort of, in a sense, died in the ditch, in a sense, on this. But we have to put these into the context of our primary objectives. Otherwise.
And sorry to press you on this, but is the addition of all these have regards, etc., a distraction then?
Well, it certainly creates more work. I mean, if you take the PRC, the Prudential Regulation, with its 31 to be 25 have regards, again, as I said, the staff have to spend time on this, and we as policymakers have to spend time. Otherwise, let's say going back to the Stonehenge thing, you find that you can actually, you'd be taken to court and lose your policy as a result. So it does take time.
Does that time spent doing that distract you, though, from other things, is what you're saying?
Well, it makes policy making more complicated. I'll certainly say that. And I want to say this: I'm not sort of saying we should just have a primary objective. Everybody should just ignore everything else. Of course, there are other things that we have to take into consideration. Much more so, it's much more of an issue for financial stability. It's not an issue, in my view, really, so much for monetary policy.
Anything else? No? Very good. Lord Davies.
Yes, well, following on from that, the primary objectives, price and financial stability, how do you think they work together? Is this something that the bank handles well? I'm sure you say yes, but is there any inherent conflict there? Is there an issue with managing both price and financial stability?
Yeah. Well, they clearly can interrelate. I think it's a great strength of our system that we have different committees, different institutions doing the two things. But then we do have to make sure they work together. And one of my jobs as governor, because I chair them all, is to make sure the pieces fit together. And often, monetary policy and financial stability are complements. And I would say actually they're always complements, but sometimes you can get instances, and I'll describe the most recent one, where you have to think quite hard about how they fit together. So the most obvious recent case is the pension LDI case last September, October. And we had to think that we had to make an intervention for financial stability reasons, because we perceived there was a serious risk to financial stability emanating out of the gilt market and the LDI pension world. My concern was that, and after quite a lot of nights spent with a whiteboard, we concluded that we had to buy gilts. We couldn't do it any other way in that particular context. And that was, of course, my concern. And quite a few people said this at the time. Well, you've just resumed quantitative easing. And the challenge there is no, of course, that's not what we intended to do or did, was how can we design and make sure we're operating a system where, as a central bank, we can operate in support of both of our financial stability and monetary policy, and not complicate the two. And just to describe what happened, I mean, with the Monetary Policy Committee, we had a meeting of the Monetary Policy Committee, and I put it to the Monetary Policy Committee very clearly and said, the test for you is not whether you, as the Monetary Policy Committee, want to make this intervention in the gilt market. The test is a different one. It's, do you have, or do we have, because obviously I'm my left brain talking to my right brain at this sort of point, do we have the tools to operate monetary policy, notwithstanding the fact that we're having to make an intervention in the other part of the landscape? Can you still achieve your objective? And what I put to the Monetary Policy Committee is that my answer to that is yes, because you can, if you want to, you can raise interest rates. So you can use it on a tool. And that was the conclusion we came to.
This was a regular meeting of the Monetary Policy Committee. You didn't convene one.
That was a special one because we were out of cycle at that point. Yeah. And it was a different sort of decision. It wasn't a decision on interest rates. It was a decision to say, have you got the tools to do your job?
That was part of the process of reconciling these two sides.
And so we came to that conclusion. It was very clear that the financial stability intervention, to use the words we used, should be temporary and targeted, that we should withdraw it as soon as we could. We sold the gilts quite quickly, actually, those gilts quite quickly. And interestingly, a number of other central banks have come up to me and said, I'm glad you went first doing that, because it was quite challenging to work out how to make the parts fit together.
Thank you. Lord Blackwell.
I'd like to ask you, Governor, about the interaction between fiscal and monetary policy. I mean, you explained earlier that your model of inflation comes back to the impact on aggregate demand. Obviously, both fiscal policy and monetary policy impact on aggregate demand as their means of acting on the economy, but they have different impacts on different parts of society. Ideally, you would think one would want to optimize the mix of fiscal and monetary policy to get the best result. Ideally, you don't want the Bank of England and the government's fiscal policy working in opposition, where escalating interest rates and fiscal measures work against each other. So is there that kind of dialogue to maintain a sensible interaction between fiscal and monetary policy? And assuming there is, how is that really different from what went on before the Bank of England independence in 1992 onwards, once an inflation target had been set? Because you could argue that it was the setting the inflation target and the government's commitment to an inflation target that provided that discipline. And even though the Bank of England wasn't independent, if the governor at the time had made it clear he disagreed with what the government was planning to do, that of itself would be a major discipline. Ultimately they could resign. So, is that dialogue happening? Because presumably it must. And therefore, what impact has independence had?
Well, our approach to setting monetary policy is that we condition our judgments on what we call announced government policies, of which the most important one is fiscal policy. So we always take announced government policy as the condition. And I should say, it's a point I think I made the other day in the Treasury Select Committee, of course, when we talk about our forecasts, they are always conditional forecasts. So, and that's one reason they change, because the conditions change. And fiscal policy is one of the conditions, and things like energy prices are others. So we always condition on what the government's announced policy is, and what the effects of that policy is. And we talk quite a lot to the OBR about what they think the effects of fiscal policy on the economy are going to be. And I think that's important. What I should say does not happen is that the Chancellor and I do not have conversations which go along the lines, well, if you do this, I could do that, or why don't you do this and I'll do that. That never happens. We do talk about the economy a lot, as I think you'd probably expect. I mean, we share views on what's going on in the economy, why we think things are happening in the economy, but they are sort of step back from policy. So we don't have the trade-off type discussions, and that's, I think, a crucial part of the system we have. So, we don't coordinate in that sense policy. We do, as I say, we always condition on what we think fiscal policy is going to be, and I think the OBR always conditions, in terms of monetary policy, on the market path of interest rates.
But is that a missed opportunity? I mean, if you're not exploring the trade-offs between monetary and fiscal policy.
I don't think it is. I think it's important. I mean, I think the value of having the independent framework is important, and therefore it's, you know, in a sense, I think it overrides anything you feel you could get from those conversations, because I think the problem is those conversations quickly undermine the value of independence and the value of the framework. But it's important to talk about the economy. You know, when we're trying to work out what's going on in food prices, you know, I'm very keen to talk to the Chancellor and talk to the government and say, well, you know, what are you seeing? I mean, I'll tell you what we're seeing.
And one of our previous witnesses pointed out that since fiscal events are maybe twice a year and the MPC meets many times a year, ultimately the Bank of England therefore has the final word on aggregate demand. And that, I mean, do you think that level of independence is appropriate?
Well, I think that's a question for the Chancellor, really. I mean, the question, I suppose, is one of, if you set fiscal policy only twice a year, you know, what happens in between? I think that's really one for the Chancellor, not for me. I think we say we have to use a conditioning assumption, and I think this is the most sensible one to use.
Well, at the lower band of interest rates, this is where, you know, potentially there could be questions raised about the bank's independence and its interaction with government policy, where since you can't use lower interest rates, or you haven't been able to use negative interest rates, the impact of using QE and the impact of raising interest rates on the government borrowing requirement. I mean, are these issues where it has tested and now rates are rising, will test the bank's independence?
I think at the lower bound, there is a change, and it's an important change, and it's this, that obviously when you're not at the lower bound, if, let's say, the government expands fiscal policy, we then have to decide whether we offset it and how we offset it if we think that's the appropriate thing to do within the inflation context. Obviously, let's take it as read that at the lower bound you're saying, well, monetary policy is in some sense constrained. Then I think you would obviously naturally therefore offset fiscal policy less, because you wouldn't want to offset it in that sense. And indeed, you would in a sense be letting fiscal policy come through more because monetary policy is constrained. I don't think that affects the basic independent structure. I think the independent structure is the same, but fiscal policy would, and that's why people say fiscal policy is, becomes more of an issue at the lower bound, more of a profile, and that's natural in a sense if monetary policy were to be constrained in that sense.
Okay, just before I finish, can I just go back briefly to the earlier point about rerunning history with the lessons learned? Are you saying? Because you're saying effectively the inflation was caused by these supply side shocks, that those who say you could have reduced the peak of inflation or reduced the level of inflation through monetarist policy, by not having had such easy quantitative easing or such a long period of low interest rates, are wrong?
Well, I don't take the view that in the contributors to inflation that QE was a significant contributor to it. I think these external shocks have been much more the contributors, I'm afraid. I think I'll come back to the point that I think if we want to go back and rerun policy, I think we have to consider what are the consequences of alternative policies, given particularly the impact the external shocks have had on national income in terms of trade.
Lord Templeton, do you want to come in?
You say you base your actions on announced policy.
Yeah.
What do you do when the government itself isn't following its announced policy? As it has it on road fuel duty, it's set this in an escalator since 2014 and hasn't put it up. And yet you seem to be forced to assume that against all previous experience, next time they will put it up.
Well, I think I still think the most transparent and straightforward thing to do is to take announced fiscal policy as is, as it were, and to condition on that. As I said earlier, there is always a debate we have, and the OBR and the Treasury indeed are a part of this debate about what is the impact of fiscal policy measures, not monetary policy, fiscal policy. But I do think it's a condition of independence, if you like, that we take what the government tells us as the policy. And you're right. I mean, look, it sometimes doesn't turn out, but I think it's important in the framework that we do that. But so the forecast is always. I mean, it just come back to a point I made earlier on. I think when Lord King asked me, it's important to remember that we don't make monetary policy in a sausage machine in that sense. So there is always judgment in there.
Thank you. Lord King.
To follow on from Lord Turnbull, one example of this is that the current fiscal framework has the property that as long as you can claim that you're going to see a fall in the ratio of national debt to national income 5 years down the road, then that's fine. But then the next year, instead of that promise being changed to 4 years down the road, which it ought to be, it's still another 5 years down the road. So what you end up with is governments who promise fiscal tightening in the future but never get round to delivering it. Is this a challenge and a problem for the bank?
Well, I think that's why it's helpful, as we do, and as in fact, we owe this to you, that we have this sort of distribution of risks approach towards it, and we can build that up. And by the way, I should just correct what I just said. We do not build the risks up bottom up. We don't sort of say it's a bit of this and a bit of that. I mean, it's a top-down view, but we can incorporate a lot of underlying judgments into there, and it is a safety valve in a sense to accommodate quite a lot of things, of which that might be one. Yes.
Yeah, thank you.
Just before I turn to Lord Vergy, sorry, Mr. Governor, I just want to check one point then. Bringing together various answers you've given. So you say that there isn't one model, there are a number of models, and you don't just treat them like sausage machines. So coming back to Lord Blackwell's point about lessons learned, the lessons learned, as you yourself are saying, are more about the judgments made in that period than about the models, yes?
Yes.
And so the judgments made by the group of the MPC, and so when you're looking at the judgments made, therefore we're looking at what, I'm just trying to tease out a bit more about where you're going to be looking in response to these lessons. Is it the appointments to the MPC? Is it about how what is it that you're
Well, let me give you one example, a prominent example for me. A lot of I remember getting quite a lot of questions in parliamentary committees when we were going through the early COVID period about how much scarring, to put that phrase, there was going to be on the economy. And I think a lot of the thrust of the questions at that time was, how much sort of capacity destruction was COVID going to cause. I think what we look back from today, I think this quote scarring is more on participation in the labour force than on sort of companies failing, for instance. And I think that's something that we need to go back and look at and say, what could we have seen at the time that might have helped us in that respect? I think that is a good question.
And final question, sorry, Lord Vergy, but in terms of that period when a number of people, ourselves included, were saying, watch out, we don't think that inflation might be transitory. In those discussions, internal discussions, was there significant challenge from individuals in meetings saying, this actually may not be transitory, it may be persistent, mindful of, for example, picking up on some of the reviews the bank itself has done on how there needs to be, I see a recommendation, challenge convention more, challenge and avoid groupthink, mindful of those thoughts that have been put to you by previous reviews. So was
that challenge built up as 2021 went on, and indeed, I would say I was part of challenging myself in that respect. Actually, I remember making a speech in September 2021 saying, I think the supply chain shock, it does have transitory elements, but even by then I was worried about what we were beginning to see. What were we seeing? We were puzzled by the labour market at that point.
Right.
I mean, it's interesting. I mean, I'm sure there will be many pieces of work done on that. I mean, there's a recent paper which is getting a lot of attention in the US by Ben Bernanke and Olivier Blanchard, which is attempting to sort of, it's accounting, it's not behavioural in that, it's accounting. And the US actually, by the way, had, of course, a very different pattern of shocks to Europe, because the Ukraine effect is nowhere near like it is in Europe. It still looks like that in 2021 it was more the transitory things than the more sort of potentially permanent things that were driving it. But it'll be interesting to see what when that's done for the parts of Europe, if it is, what that looks like.
Right. Thank you. Sorry, Lord Virgie.
Thank you, Chairman. Afternoon, Governor. Can we shift to the regulatory framework?
Yes.
And how confident are you that the current regulatory framework can identify nascent systemic risk? You take Silicon Valley Bank, of course that's in America, but there are lessons to be learned from that. In hindsight, it's pretty obvious that interest rates going up, there was a pretty obvious systemic risk lurking around there. You have your international protocols, and then with Credit Suisse, again, those were just pretty much torn up in 24 hours. That's question number one. And question number two, can you give us some commentary on the tension between monetary policy and systemic risk? Interest rates at 8% might be needed for inflation, but that's going to cause real systemic risk. Could you give us some commentary on that tension?
I think this is why our structure. I do think. I mean, one of the great strengths of our structure is that the FPC and the MPC are separate bodies, and that's not the case in most systems actually, because I think one of the consequences of that is that this having the FPC is that it is much more focused on tail risks. It's its job to look at the tails of the distribution. And one of those, exactly to your point about interest rate risk, is that we have run stress tests pretty regularly based on a rates up scenario. So in other words, quite a rapid rise in interest rates, usually into some form of recession, to create the stress, because you have to sort of create the stress, as it were. And I think the FPC structure has been more rigorous in that respect in terms of doing it. I'm not, I don't want to tempt fate. One of the things we do, and I think this is important to the causes, is that, I mean, the interesting thing with Silicon Valley is that in many ways, the root of this issue is something that is almost sort of 101 stuff. It's interest rate risk in banking operations. It's not trading, it's banking operations. We do have what we, under the Basel structure, call a Pillar 2 regime, which is interest rate risk in the banking book. So we require our banks to hold capital against that risk. We also, I think the European system.
Sorry, that differed in the US?
Yeah, it does. For the regionals, I think the US structure does differ a bit between banks, but I think the mid-tier banks in the US do not hold interest rate risk capital against interest rate risk in the banking book. The other thing I should say is that I think this is Europe, not just the UK, that the accounting regime means that far fewer of the assets are held at historic value. And that's important. More of them are marked to market and fair valued and marked to market. And that reduces the interest rate risk exposure. So put those two things together, the accounting treatment, and then once you've done that, the risk, there's the risk testing for interest rate risk, I think has put our system in a better place. Now, I think that is, we get a more robust outcome in that process by having the two policy-making areas separate, but obviously interacting where appropriate. I think the FPC is very rigorous on that sort of thing. On Credit Suisse, the second part, I'll come to a third part in a moment. I think Credit Suisse, was where Silicon Valley was a very fast-moving the failure. Credit Suisse wasn't actually. In some ways, approximately it was, but actually it had been a firm that I think we know it had problems for some time. I think the critical question now with Credit Suisse in the aftermath is actually about resolution policy. I think there has been an assertion that the resolution plans that we've developed ever since the financial crisis for these globally systemic banks, Credit Suisse suggests they don't work. I have to say, I'd say two things. Obviously, we need to test that assertion because we can't sweep it under the carpet. I am sceptical myself that the evidence. I don't, as a starter, think that case has been made, but I'm very clear that we have to test it since it has been asserted that the sort of the bail-in plan structure doesn't work. So that's an important point coming out of Credit Suisse. The third thing to your opening question about sort of systemic risk more broadly. So I think what we learned from recent years is we spent a large amount of the post-financial crisis period focused on the banking system, and we still have to be focused on the banking system as recent events have shown us. But we're having to spend a lot more time now on the non-banking world, and rightly so, because in a way I think one of the consequences of the financial crisis and the re-regulation of, or the regulation of the banking system following the financial crisis is that there was a shift in the sort of the distribution of intermediation from the banking system to the non-banking system. Now, we shouldn't be surprised at that, and indeed much of it we actually wanted because we felt there were assets in the banking system that shouldn't be there in terms of their characteristics. They were not the right assets to, in a sense, be on the other side of the balance sheet from deposits. But we have now got more systemic risk in the non-bank world, and exactly to your point, one of the, and this is both a global and a national point, we have to do both, is that the non-bank landscape is very big, it's quite dispersed, and we have what I call the breadth and the depth problem. The breadth problem is it's as big as it is. The depth problem, I'll just illustrate. The LDI incident illustrates this very nicely. Unfortunately, it's the only thing that's nice. So there were two sorts of LDI funds. There was what's called segregated funds and pooled funds. The segregated funds were the big funds. 85% of the LDI world was the segregated world. So big pension fund has segregated as its own LDI fund sitting off it. And then we had the pooled world for the smaller funds, 15% of it. It was the pooled system that essentially was the problem. Because you had it's quite a complicated legal entity structure, and those funds were not able to in a sense, call down the liquidity from their many parent funds in the way that the segregated funds were. So the lesson I take from that, unfortunately, is that we have to get the right combination of breadth and depth. Because otherwise, we're getting bitten by things that we tend to think, well, it's obvious you should look at the 85%. Surely that's the big part of the system, and then it's the 15 that sort of, rears its head.
Well, King, what's going?
You mentioned resolution schemes, and you said we haven't really tested them fully. I think from my experience and from looking at the outside at some recent events, politicians seem unable to resist getting involved in resolution when it occurs. The Swiss authorities certainly decided that it was better to impose losses on creditors than on shareholders, the reverse of what would normally be the case. And I know that in the UK that could not happen, partly because of the actions of the House of Lords when the resolution legislation went through. But were you at all concerned when the one bidder for SVB UK managed to get a relaxation of its ring fencing requirement?
Well, the problem we faced is this. To get a sale of SVB UK to a large bank, and there were no other bidders, by the way, it would have fallen through otherwise, because I'm a supporter of the ring fence, but here's a challenge it gave us. We would have had to split SVB in two, because you couldn't put the liabilities and the assets in the same legal entity and maintain the ring fence. That was the essence of it. And it's not because it was investment banking, it was sort of startup corporate banking was their business. And that was a challenge. The resolution wouldn't have happened if we tried to split it into two. That wouldn't have happened. And then we'd have been faced with the choice of other instruments, putting it into the insolvency procedure. I'll come back to that in a moment. Or a bridge bank, but then that goes on to the liability, goes on to the public purse at that point. So that was the challenge we faced, and our judgment. And I think it's, I talked to the Chancellor, I talked to the Prime Minister about this, and I think it's appropriate in that situation. That's where I think it's appropriate we do talk, frankly, and we do have quite open discussions about what to do. And I welcome their input actually. That was a tough decision. I think it was the right thing, but I think we have to be clear that this is not a sort of coach and horses going through ring fencing, which is open. Once you put a small hole in, the thing just gets bigger and bigger. I think it's really important that we don't do that. The other challenge in this, and this is something that we are thinking very hard about, it is, and this is actually interestingly for small banks, not big banks, is, and you see this in the US as well, by the way, is are we at a point where it is acceptable to impose losses onto uninsured deposits? Or is the sort of the concept of money in terms of commercial bank money and bank deposits really saying, no, you can't do that? You can in the investment world, which is not money, but you can't. And that's it's an interesting piece in The Economist, I think, the other day on this. Actually last week, or the current one. We have to get to the bottom of this question, because we don't want to end up having, Credit Suisse aside, having tackled too big to fail, but we've now got a too small to fail issue because of how we manage these tools, these resolution tools, and whether you can or cannot end up with uninsured depositors taking losses.
You're attracted by a scheme that would limit the size of these very short-run liabilities so that you could provide adequate liquidity to all the depositors?
Well, on your pawnbroker, so can I say two things which go in different directions? And you, forgive me, tell me if I've misinterpreted it. I think the basic ratio is actually really very interesting and a good one to look at, which is, in other words, I take to be the sum of the high quality liquidity plus the haircut, the value of the assets that they position at the central bank minus the haircut. And actually you learn a lot by getting those ratios out, I think. Where I might differ, and I say you can please feel free to answer back, is that I do think, however, that it's not really a substitute for capital regulation, because the key in there is then the central bank haircut, I think.
Let's not go into that.
No.
But I take it from what you said on resolution that I don't challenge your decision at all, but you seem to have accepted that in a resolution politicians are just going to be involved one way or another if they wish to be.
It's not like monetary policy. I don't think we're going to have independence in that sense, because it's obviously a very, very high profile decision to take. People were lobbying me over that weekend. This is again, if we'd put it into the insolvency procedure, by which by the way, I don't think they would have lost money, but the problem is that it would have got tied up. Their working capital of these businesses would have been tied up for too long. That was the problem. And and I totally accept this. I mean, I was getting, for instance, in the biotech world, people saying, you really are going to set back, curing disease. No pressure then. But I say that because I think we have to think, we have to take the lessons from this and think, well, what does it tell us about the regime? And I do think that's an area where we do need to talk to the government about this and say, we've got some choices here. So the Chancellor and I are talking quite a lot about this. We're both very interested in the subject and want to get a sensible outcome.
Thank you. Lord Verger, did you have anything you want to?
No, I'm good. Thank you.
Lord Davies quickly, and then Lord Turnbull. We're running behind time, so I'm sorry.
I'll pass.
All right.
Okay. Lord Turnbull.
If you think if you've got 4 blocks of policy: monetary stability, financial stability, prudential stability of banks, insurers, and financial conduct. And after 2010, we split them, dealt the cards in a different way. Conduct went into one organisation, the other 3 have come to you. From your previous answer, I suspect you're not going to say we did it wrong. I think you probably like that and think it. And from a banking point of view, it's probably a good idea. From the point of view of the regulated, they're not so happy with it because they've got 2 people that they've got to deal with. And there's then a different question, which is within the bank, You have these they have these three committees. You go chair them all, which is probably correct. But you go along with three supporting knights. You've got 4 deputy governors, and to each one of them you take 3 of them. There's not the same 3 in each one. So there's a very solid, let me call it a caucus of the executive. Now, in the face of that, and you're working with the other 3 day in, day out. You've then got the externals, and they're not full-timers like you. Do they really stand a chance to make their impact when there is such a solid solid block of externals, more or less the same for each of these committees?
Well, I think it's part of my job to make sure they can. I mean, I do take the responsibility to make sure that they can do that. And I was interested, actually, you had Don Cohn appear before you, and Don is somebody I have absolute huge respect for, and he was on the Financial Policy Committee for until not that long ago, actually, and we were incredibly lucky to have him on the committee. And he made the point, and I'd actually take it further. I was very interested. He said this. He felt that his job was to challenge the executive and to put them back on the right course when they sort of veered off. And I can understand Don saying that. I mean, I would say, having been on the FPC for the whole length of time, he did a lot more than that. I mean, he was one of the movers and sort of shakers of the policies we made. I thought in classic Don fashion, he understated his contribution massively. And that's where the externals do. But it's my job, and I take this very seriously, to make sure they can do that. And to make sure they get all the information they want. They're briefed when they want to be briefed. They can come into the room and, advance arguments. They've probably got, the funny thing is that the externals, of course, have got more time than I've got to do these things because they've got narrower responsibilities. My job, of course, as I said earlier, is that also I have to see the whole picture, and that's important. By the way, I should say the legislation that's going through, part of which you were voting on, is going to create a 4th committee for financial infrastructure, which I am not chairing. One of the deputy governors is going to do that. I'm free as many as I think it's sensible for me to do.
We're going to stick with 4 deputy governors. I mean, how far back in history do you have to go when there was just one?
1996, I think. Yes, when 97 reforms.
In fact, technically, no.
Well, it was a sort of year later, wasn't it? Technically, but yeah.
In 98.
That's when Lord King became a deputy.
You've got that right, or is?
Well, Lord King, I'll be honest. I mean, the responsibilities of the bank in those days were rather different in a way to how they are now. I think it's essential. I mean, each of the deputy governors runs quite a large area of the bank, and that's important. And by the way, of course, there are important parts of the bank that are not within the statutory policy. I mean, we're running parts of the critical national infrastructure, for instance, in payments, and in the moment replacing it. So there are very critical areas that are outside this world as well.
Can I just quickly come back to the FPC? Paul Tucker, when he gave evidence, he said for the FPC the big thing is to introduce voting in some respects. The cost of not having votes is that we can never really see where the debate is, and that hampers accountability. How would you feel about voting?
I think the difference between the MPC and the FPC at the sort of basic level is that the FPC has one objective, and it's a numerical target, and you can vote on it. The FPC, I always say, is a bit like one of these old-fashioned signal boxes where you're sort of pulling all sorts of levers in combination. And I don't think that lends itself to a voting model. I know people say we could vote on the countercyclical capital buffer. I prefer to say, and I think Don Cohn made this point, and I will take this point away as well, that I think the better debate there is that we make sure that the record and the minutes or the record of the FPC sets out the different views that are taken within the committee on that. I think that's frankly a better way of doing it. I think the FPC works well on its current consensus basis, would be my view.
Thank you very much. Lord Rooker.
Afternoon, Governor. Do you believe you're a good communicator?
Well, I try hard. Can I tell you? I mean, it's a great question. I'll give you the challenge. I think it's necessary in the world we live in now, particularly with independent responsibilities, for central banks to talk not just to what I might call sort of expert audiences, not just to financial markets, but to talk more broadly, including much more to the public directly. I think we all have to adjust to that. I have to adjust. I know I have to adjust to that. We have had some times, I think, in the last 2 years when we haven't got it right. I respect that. I think it's been very difficult communicating the issue of the effect on real income that these shocks have had. So we are in a changing world, and we have to adapt to that, and I recognise that.
I mean, you've said you're following out evidence closely. I mean, we've had more than one witness suggest that central bankers talk too much, which can cause volatility, uncertainty. Is there a case for more constraint, while being more open? There's a contradiction there, but it's not quite so, because it depends which audience you're talking to.
It's a point of subtlety, actually. I have to say, actually, because I do obviously follow the hearings closely, one of the witnesses said that we talk more than other central banks, and I must say, I read this and I thought, really? I'm not sure. So I looked up the comparison of the MPC with the Fed board and the ECB Governing Council. And by the way, those are much bigger committees, so I didn't include the sort of regional Fed members. I didn't include the National Central Bank governors, because I know we talk a lot less on that basis. But interestingly, if you just look at our MPC and the Board of Governors and the Governing Council of the ECB over the last year, actually, we and the Fed, we were slightly, in terms of speeches made, slightly lower than the Fed and a lot lower than the ECB, interestingly, which was almost twice as much as the other two. Now, I tell you what I do firmly believe is that on monetary policy is that I always say, I do not think it is a good thing, and I don't like if people, what I call, sort of advertise their votes in advance of the meeting, because it destroys. Going back to when we started this session, it destroys deliberation. What I do think it's our job to do is explain our votes and explain our decisions after they've been made, and that's the sort of underlying philosophy that I hold to.
Okay, I'll give three brief questions. In the sense of what you've just said, have you yourself felt, either in preparing to meet us today or during the course of the session, felt any constraint in anything that you've said in answer to the questions at all?
I'm sure there will be people who will sort of pick up things I've said and interpret them. I mean, I think, we have to be very careful how we express things, because communication is very important and, quite powerful and quite subtle. But I also think it's important we say what we think, frankly.
So a central banker can say, we got this wrong, and explain why, and still maintain credibility as a central banker. Is that a fair way of putting it?
I think we have to be open to the lessons learned. I mean, if we're not, then frankly we're just not going to make good policy, is my view. I think unless we're prepared to learn lessons from experience, then we're not going to make good policy, all across the board.
Yeah. Finally, I mean, I understand your term is 8 years. Would it materially make any difference to the way you operate if it was 4 years and renewable?
Well, luckily I don't. I mean, I don't have to think about that, and I honestly don't spend time thinking about that. I've got enough on, frankly, to think about without having that thought.
Okay.
So just on the judgment point, I mean, would you, when you look back over the last few years, would you identify moments where you would say we got X judgment wrong, and we're learning the lessons on that, and maybe you'd like to fill in what the X is?
Well, I think I said earlier, I think we have, particularly 2021, and a number of witnesses here have made the point. I said to the Treasury Select Committee, we've got to obviously look and learn lessons. I think we've got to work out what the lessons are, and they've got to be based on, say, the decisions we took based on the evidence and the best judgment we had at the time. But I think if we, I have to be very robust on this, because, to Lord Rooker's point, I mean, I'm sure if I say, well, we didn't get this right, there will be lurid headlines. But the point is, we have to learn lessons. I mean, we have to be robust enough and, able to say, I take your point, but we must learn lessons from the experiences we have. Of course we must.
Very good. We've got two sets of questions left, one on the court from Lord King and another one on CBDCs from me. So just two quick.
There's one part of the bank that most people think has never changed since 1694, but you've seen over many years it has changed a lot. That's the court of the bank. Have you had any discussions with the Treasury about further changes or reforms?
Well, the court is, I mean, it's interesting. So the court, I think, has been changed by 3 times, actually, since the legislation in 97-8. It became a unitary board in 2016. It had changed in 2009-10, wasn't it, I think, when you were your time. So ironically, I mean, court has actually changed probably more often than anything else in the bank, actually. What I would say is I think court has, in my experience, court has evolved a lot over the time. It is now the governing body of the institution, and it is as near as we can get it a corporate board in that sense, in terms of many of the things it does. If you look at the finances of the bank, the budget of the bank, the risks, the people, and I value that. I mean, I value the fact that we've got a governing body that spends its time on that, because it's an enormous help to me, frankly. And I think we look to have people on court who can add value in those areas. So that for me, court has actually evolved a lot, and it's very helpful in that sense.
When you change the balance sheet of the bank to deal with a financial problem, do you have to go to court to get court's agreement?
Yes. Yeah. So if we're doing any major change to the balance sheet, the answer to that would be yes. And that comes about because court has a responsibility for the risks to the balance sheet, so that court can take a decision as to whether it accepts or not the risks to the balance sheet that are involved in any decisions we take.
Thank you.
Thanks very much. Final question from me on CBDCs. So I know full well that a decision has not been taken. In fact, we're soon going to be debating this in the Financial Services Markets Bill. So I know where the bank is on this. I'm interested in how we go to where. Well, I know that you're doing a lot of consultation on it, put it like that, and that's very welcome. One of the questions I have is, were there to be a CBDC, what impact you think that has on operational independence and your framework for operations? And I was very interested in Andrew Houser's speech on this. Just read the point. He says they, CBDCs, could have important implications for the size, composition and risk profile of our balance sheets, for the monetary policy transmission mechanism and for monetary control, end quote. To that one could add obviously issues such as privacy, cybersecurity, all the 9 yards. Just very interested to know how you, when you're looking ahead at this.
Yeah, so can I start in a slightly different place, but it's important to answering your question. I think the first question that we need to answer collectively is will there be a business need and case for digital money? Not whether it's central bank or not. By which I mean retail programmable money, in the sense that you can take a unit of money and attach programmable instructions to it on some basis that we don't have today. I don't know the answer to that question, but I think we need to avoid what I call failure of imagination. My guess is probably yes. And indeed, I think in many ways that was what Facebook were trying to do a few years ago. Now, if you do answer the question, or you think you might answer the question, then I think you've got a second question, which is, I think you've got 3 choices then, and you can pick permutations of these. You can do it through commercial bank money by creating what sometimes gets called tokenized deposits, but programmable deposits. You can do it through non-banks, through so-called stable coins, which at the moment, some of the examples we have around are neither stable nor coins, but this legislation is going to create the regulatory structure in the UK for non-bank stable coins. And the third one is central bank digital currency. Now, I think we need to look at all 3 of those. If you don't mind me saying so, I think the commercial banks, and I do have this discussion with them regularly, they need to decide whether there is a case for commercial bank digital money. Because I personally do not think it would be if we do say that the case is positive for digital money, I don't think it's the outcome we should look for, that the central banks become the only game in town. Now, I think it's important that we're doing the work we're doing, because there may be a case for having, I say, a combination of things. There may be a case for having, to use the sort of economics term, both inside and outside money in that world. I think that's an argument still to be proven. I am very focused on the fact that if we only have central bank digital currency, there are very big questions about its impact on credit creation and economy, and there are very big questions about how it would behave in a stress. because it's about access to central bank money. But I do think we've got to, in a sense, step back first and say, is it right to plan for a world in which there is digital money, and in which case, what does that imply? And I do think, because central banks, money is such an important part, as Lord Griffiths was saying about central banks, that we need to be knowledgeable in this area. So I'm very supportive of the work we're doing, but I'm still, I'm jury out, and I do think the banks need to consider this as well from the point of view of commercial bank money, because that would, of course, help to preserve broadly the monetary system we have today.
And I hear that. It's quite a cold shower on certain, the digital pound, it sounds like. As you say, the jury's out in your mind, which is quite interesting. In terms of, though, the operational framework for independence of the bank, how, if you go down the digital pound route, as Andrew Heiser spelled out, and as our report spells out, that it raises a lot of issues. I mean, how do you see this impacting?
Well, I mean, first of all, I should thank you for quoting Andrew Heiser's speech, because he's an incredibly thoughtful person on these subjects and on the bank's balance sheets, and I'm very, very lucky to have him as a colleague. And he's right that, of course, in an extreme world, we could end up in a very different world where the central bank's balance sheet is a very much larger proportion of the monetary system than it is today. Personally, I do not think that's the world we should aim to end up in, frankly. I do not think that's the world we should aim to end up in, because it brings all sorts of issues with it. But that depends if there is a future in digital currency for what sort of combination of innovations we have. And I mean, thank you for asking a question. You might say I'm very keen to sort of say, can we try to position the debate in that way?
Very interesting. Thank you very much. I don't know if colleagues have got any other questions. We're almost exactly on time, which is fantastic. Thank you very much, Mr. Beatty. Very, very kind of you to come in and for answering all our questions. With that, we will end the session.